Hello everyone, I'm pleased to welcome you to this webcast on the new Section 12 of the third edition of the IFRS for SMEs Accounting Standard called Fair Value Measurement. In this webcast, we'll explore the key features of the new Section 12 of the standard. We'll start with the new definition of fair value, including the underlying measurement principles. Then we will talk about the fair value hierarchy, which comprises the three levels at which inputs are classified. Section 12 includes a few disclosure requirements, which I will highlight before closing with an explanation of how SMEs will apply Section 12 when they make the transition to the third edition of the standard. In the second edition of the standard, requirements on fair value were included mainly in the sections on financial instruments. Those relating to non-financial assets and liabilities were set out in other sections. The IASB decided it would be more helpful to place all requirements on fair value into one section for ease of reference. The new section does not introduce any new requirements to measure assets or liabilities at fair value, but includes a new definition of fair value together with clarifications of all the elements of that definition. The new section also introduces more structure based on a hierarchy. So what is the new definition of fair value? An asset or liability's fair value is the price that would be received to sell the asset or paid to transfer the liability, also known as the exit price, in an orderly transaction between market participants at the measurement date. Each of these elements of the definition is important, and underlying the definition is the vital point that fair value is determined from the point of view of market participants, not of the entity. In other words, the value doesn't represent an SME's intentions or abilities, but instead reflects how market participants would value the item. This market-based approach to determining the fair value of an asset or liability results in a valuation that is realistic instead of conservative. An SME determines fair value based on the principal market for an asset or liability. That is, the market with the greatest volume and level of activity for the asset or liability. If there is no principal market, the SME must look to the most advantageous market, that is the market that maximizes the amount that would be received to sell an asset or minimizes the amount that would be paid to transfer a liability, assuming it has access to that market. The valuation takes into account factors that market participants would consider, including the item's condition and location, and any restrictions on its use or sale. For instance, a property for sale might have covenants that might restrict how it could be developed. These covenants could affect the property's appeal to market participants, potentially reducing the price to less than they would have paid for a property without these restrictions. For the purpose of establishing the highest and best use, an SME ignores transaction costs. However, the item's location needs to be taken into account if this location is a characteristic of the item. In valuing a non-financial asset, Section 12 requires an entity to determine an asset's highest and best use. This requires an entity to first determine what an asset's highest and best use is to all market participants who could be looking to acquire the asset, and not necessarily the purpose for which the entity is currently using the non-financial asset. Section 12 includes extra guidance about how to identify the highest and best use. All the factors in determining the highest and best use shown at the bottom are considered from the point of view of market participants. So, for instance, there could be uses that are not financially feasible for the SME that is valuing the asset, but that could be financially feasible for potential buyers. That's some of the theory about how SMEs determine fair value. The obvious next question is how the valuations are performed in practice. Sometimes there will be an observable price for an identical asset or liability, and in this case, no valuation techniques are needed. Otherwise, Section 12 requires SMEs to use a technique consistent with one of the three approaches listed here. The chosen technique should maximize the use of observable inputs and minimize the use of unobservable inputs. The market approach is self-explanatory. For the cost approach, one would estimate current replacement cost, which is the amount that would be required currently to replace the service capacity of an asset. We've listed a few different valuation techniques under the income approach. They all convert future amounts to a single current discounted amount. On the previous slide, we saw that fair values should always use observable inputs if available, instead of unobservable inputs. Section 12 represents this idea using a hierarchy, which helps SMEs to work out how to value their assets and liabilities, and also drives disclosures, as we'll see later. Let's talk about the theory here before going on to some practical examples. It's easiest to look first at the top and the bottom of the hierarchy, since all other inputs fit in the middle. Level 1 inputs are the gold standard, being unadjusted quoted prices in an active market. They are observable and reflect the views of the market. At the opposite end, level 3 inputs are unobservable and give rise to the least confidence because a third party cannot access them easily. In the middle, we have level 2 inputs. These fall short of level 1. For instance, they might use observable inputs, but adjust these for other factors that are unobservable, or they might use observable inputs of a lower quality than those classified as level 1, such as prices that are not quoted or prices quoted in a market other than an active market. Here are some examples of assets for which an SME might need to find the fair value. The slide also shows where the inputs might be classified. You can read more about these examples in the educational module on Section 12. An SME with a small investment in quoted shares would be able to use level 1 inputs to value that investment. In other words, the published share price. If the SME holds an investment property, Section 16 of the Standard, Investment Property, permits that property to be measured at fair value. The inputs will be assessed as belonging to level 2 if they use recent observed per square meter selling prices for similar properties in a similar location. These are observable inputs, but of a lower quality than level 1 inputs. Finally, an SME might hold a field of sunflowers, which at its reporting date are not yet ready for harvest. Section 34 of the Standard, Specialized Activities, requires that the harvest be measured at fair value if that is readily determinable without undue cost or effort. Generally, sunflowers are valued on a per head of sunflower basis. Although the SME can refer to its historical prices per head and can measure its field area in approximate heads per square meter, other unpredictable factors such as the weather between the reporting date and the harvest date can affect the number of heads harvested, as well as their size and quality. The expected future selling price would need to be adjusted for these factors. Consequently, there is no suitable quoted price in an active market to use in the valuation. The inputs into the valuation would therefore be classified as level 3. Moving on, the disclosure requirements now included in Section 12 will help users to understand whether an SME has measured assets at fair value and how it has determined that value. The disclosures should not be onerous to prepare, as they are a simple report of the process an SME will have gone through to reach its fair value measurements. The requirements on the left apply to each class of assets and liabilities, not each individual item, measured at fair value. Section 12 is not prescriptive about what constitutes a class, but says classes should be determined on the basis of the nature, characteristics, and risks of the asset or liability. The requirements on the right apply only to assets or liabilities for which recurring fair value measurements are classified in level 3 of the hierarchy. Because there is some extra uncertainty associated with these measurements, users like to understand when an SME uses unobservable inputs. These disclosures achieve transparency by reflecting the fair value gains or losses in each period and specifying where these gains or losses have been recognized. Finally, let's discuss the transition to the third edition of the standard. The IASB has made things as straightforward as possible for SMEs. There is no requirement to apply the new Section 12 retrospectively. So, if an SME applies the third edition of the standard for the first time in its financial year beginning 1 January 2027, it will not restate the 2026 income statement and balance sheet. Also, the SME does not have to provide comparatives for the new disclosures. Now that we've reviewed the new Section 12, let's look at what other resources are available to support an SME's transition to the third edition of the standard. The IASB published a project summary and feedback statement and effects analysis alongside the third edition of the standard. It also published a version of the SME standard showing changes since the second edition. The IASB technical staff is also updating the educational modules, prioritizing the sections with significant changes. These modules provide support to anyone learning about or applying the standard. The updated version of Module 12, covering Section 12, is now available. Quarterly newsletters and a podcast series dedicated to the standard are also available. The newsletter summarizes news, events, and other information related to the standard. The podcasts offer bite-sized insights to support implementation. Finally, you can submit implementation questions about the standard at any time to be considered by the SME Implementation Group. You will find a link to submit questions on the Supporting Implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. Until the next webcast, thank you very much for watching and listening. Bye.